Hello, welcome to our monthly performance monitor. My name is Colin Beveridge, Chief Investment Officer at True Potential. Now, August was a good month for risk-based assets like equities. They're performing well despite a backdrop of continuing geopolitical tensions. In bonds, it was the higher risk categories like high yield and emerging market bonds that produced the best outcomes. Sterling weakness also contributed to a generally positive return for multi-asset investors. In fact, the pound fell by more than 2% against both the euro and the US dollar. Now, this produces a sizable tailwind effect, boosting returns from global equities from 0.2% in local currency to 2.5% in sterling. In terms of individual equity markets, US stocks reached new record highs in August. Sales of US goods, helped by a weakening dollar, boosted corporate profits. This is like what is happening here at home, with UK multinational companies also gaining a competitive advantage from sterling weakness. In the UK, equities and gilts returned 1.7% and 1.8% respectively over the month. This was despite ongoing worries over Brexit. In fact, investors appear to have concluded that potential interest rate rises will be pushed further out to ensure maximum support for the economy as negotiations over exiting the union unfold. Elsewhere, economic activity is picking up across Europe. This is self-feeding, with European business confidence surveys reaching new highs. The euro has also significantly strengthened, helping enhance returns for UK investors owning European shares. This month, European index returns in local terms fell by 0.4%, but were up 2.5% in sterling. Looking ahead, analysts are pondering the effects of a strong euro and whether it will impinge on the competitiveness of European businesses selling goods internationally. So far this year, the major developed equity markets in the UK, Europe, US and Japan have all proved rewarding. However, in just August alone, emerging market equities returned 4.6%. Emerging market bonds also proved attractive, producing a return of 3.9%. In fact, for the whole of this year, returns from emerging market equities now exceed 20%. The key drivers propelling emerging market returns are a weakening US dollar and a supportive global economy. Improved economic data from China has also been a key driver behind Asian market equity returns. In August, Asian equities lagged EM equities, but only slightly, delivering 3.4% in sterling and 1.1% in local terms. In commodity markets, tensions in North Korea pushed gold to a 9-month high, with investors purchasing safe haven assets. Hurricane Harvey in North America is also causing massive disruption to oil refineries, transportation, and energy infrastructure. This has put pressure on the supply of gasoline, causing prices at the pumps to soar 15.2% over the month. As usual, keeping track of so many events taking place globally and spotting profitable trends is extremely challenging. The strong and special relationship we have with our 8 world-class managers makes implementing advanced diversification across multiple asset classes, styles, strategies, and investments manageable. In our opinion, the benefits from advanced diversification remain steadfast. This is even more evident today when managers managing single asset classes are discovering that being concentrated in one area can deliver negative as well as positive surprises. Thank you for listening.